Welcome to the Georgetown Passaro Center for Financial Markets and Policies virtual FMQ webinar on crypto regulation. I'm Reena Aggarwal, Robert T. McDonough Professor of Finance and founding director of the Passaro Center. Last year, Mike Passaros and his family made a large commitment to endow the center. Their gift makes it possible for us to establish the Georgetown Passaro Center as the preeminent destination for unbiased expertise at the intersection of finance and policy. Financial markets are undergoing transformational changes with focus on AI, crypto, digital assets, growth of private markets, climate risk, and there's a re-examination of several fundamental market structure regulations. Some of these issues didn't even exist a few years ago. Policymakers and regulators around the world are quite busy addressing these issues. We at the Passaro Center are using our expertise to help both policymakers and market participants by providing objective, research-driven, trusted expertise. There's a lot of information out there, but the Passaro Center brings something very valuable to the table. We are an intellectual, honest broker, a facilitator, and an educator for practitioners, policymakers, and the wider community seeking unbiased expertise. There's much work to be done in this area, and we at Georgetown's Passaro Center are ready to do this work. Today's event is focused on the timely issue of crypto regulation. We're absolutely delighted to welcome Jay Clayton and Tim Massad. Jay Clayton was chair of the SEC from 2017 to 2020, and now is a senior policy advisor and off counsel at Sullivan and Cromwell. Jay, welcome back. You have participated in the Passaro Center events in the past. You have spoken, and we're delighted to have you back again. Tim,
very nice to be here. Thank you.
Great, great. Tim is the former chair of the CFTC during the period 2014 to 2017, and now a research fellow at the Mosawa Rahmani Center at the Kennedy School at Harvard University. Tim serves on the board, on the advisory board of the Passaro Center. So we'll get started right away. And let me ask the attendees, please feel free to submit your questions in the Q&A, and we'll take them up as we go along. And it's just fantastic to have Tim and Jay together, collaborating and working on issues that are extremely timely. So there's a lot going on in terms of the crypto world, the digital assets world, from stablecoins to the potential use of crypto for money laundering or illicit activities. There's the whole question of what's a commodity, what's a security, and therefore what's the role of the SEC and CFTC. Tim, let me start with you and ask you, so what are the major issues there? What can be addressed by regulators like, where you were formerly CFTC and where Jay was formerly the SEC, versus sort of where do we need Congress and legislation to step in?
Well, thanks, Reena, for having us, and to the Passaro Center for organizing this. Look, the basic problem here is that crypto trading platforms and other crypto intermediaries are essentially unregulated. And so the level of investor protection is very weak. There isn't sufficient protection of customer assets. There aren't sufficient standards to prohibit conflicts of interest or to prevent fraud and manipulation. And as you've noted, we've kind of been bogged down in this debate over whether tokens are securities or commodities. And of course, as probably many in the audience know, we don't have a federal regulator of the spot market for crypto tokens unless they're deemed securities. So the platforms, to my mind, have essentially taken advantage of this by claiming that everything they trade is not a security, it's a commodity. Now, we think the solution is not simply enforcement. We support enforcement, strong enforcement actions, but that's not getting us to where we need to be fast enough. And so what Jay and I have suggested is that the SEC and the CFTC could simply get together and draw up some standards, because the standards we need are essentially the same, whether a token is deemed a security or a commodity. You want protection of customer assets, prevention of fraud and manipulation, prevention of conflicts, and so forth. And they could do that and essentially apply those to any platform that's trading Bitcoin or Ethereum today. Now, they haven't done it. We think they could do it on their own. They haven't done it. We think Congress could mandate it. And, Congress is considering some different approaches to regulation, but there's no consensus because you have such a wide set of views in Congress on what to do about this. And some of those proposals involve rewriting essentially definitions of securities or possibly changing standards that have been around for a long time. And those things could have unintended consequences. And that's why we think the approach we've advocated is simpler. It would be much easier to build a consensus around it. And it would basically not change the SEC and the CFTC's respective powers. It would simply be a way to implement some basic investor protection standards on these platforms as they exist today.
So, Tim, I want to come back to your proposals and what Jay and you have proposed. Let me go back to something that you brought up, kind of the enforcement approach that seems to have been adopted, and the market is obviously not thrilled about that. Jay, where does the enforcement approach work, and where does it not work? Is this a solution in any way?
So, unfortunately, in the debate, this is often a binary argument. You hear this phrase, regulation by enforcement. How about turning it around and saying enforcing regulations? Because what the SEC has largely done, and I was very proud of the work we did there, the SEC enforced the basic capital raising regulations. I would like to be clear for, I don't know, the dozenth time, the 100th time, if you are raising capital from the general public in the United States, where the public is looking at this as an opportunity for a return based on the venture, the project, the network being built out and being taken up, that is a securities transaction. That's how broadly we define securities transaction. And whether people like it or not, capital raising of that type is a securities transaction. The other thing that we have in the United States is if you're engaged in a public offering securities transaction to raise money, you are the most regulated person in the world. Our public capital markets are regulated to an incredible extent, all built for giant companies. Now, that can be frustrating to entrepreneurs, but that's the law. And I think the SEC has done a very good job of establishing that law in the capital raising area. Tim is right that in the area of secondary trading, whether you're secondary trading a security or whether you're secondary trading a commodity, there is more room for debate. We regulate that differently. And that's why Tim and I have such a meeting of the minds, because this technology, crypto is a technology, it's not a product. This technology has facilitated secondary trading in many things that may not be securities. And we should tackle that issue head on. But on the capital raising side, anybody who says regulation by enforcement, you know what? They don't know what they're talking about.
And I would just add, I mean, I think Jay and I support the enforcement actions, even in secondary trading areas that the agencies have taken. We're just saying, look, these cases take a long time. They're complicated and you don't always win.
You don't always win. And again, in capital raising, I don't see much room for discussion, argument, ambiguity in the regulation. In secondary trading, of course there is, because we trade all sorts of instruments that are securities, not on exchanges.
Right.
Bonds, RMBS, all sorts of things. Yeah. We trade all sorts of things that aren't securities on exchanges. And what Tim and I are saying is rather than having that debate in the area of digital assets, let's try to move it forward and provide a safe place to trade.
Yeah, so capital raising is clearer, right? So for example, ICOs, very clearly they were raising capital and the SEC clamped down. And I don't think there was
no court disagreed.
Exactly.
It took courts no time at all.
Yeah, exactly. So there was no, that was very clear. I think what's happening right now is, at least the SEC thinks that there's very clear guidelines about what is a security and what is a commodity, while market participants feel there isn't that clarity.
Well, market, as Tim pointed out, market participants would love for any ambiguity to be resolved as a commodity because it's not as regulated as a security. Two quick things. We regulate securities transactions involving securities, and people also get that mixed up. So,
and I guess the thing I would say is, look, these are the crypto tokens, I guess I would regard that are being traded today are financial products, financial investments. And we just need a regulatory framework. I think that's obvious to anyone who looks at this sector and sees, the problems we've had, whether it's the failures we've had or, the fact that there is a fair amount of manipulation going on. Wash trading has been estimated to be rampant on these exchanges. Wash trading, where essentially you have someone trading with themselves to artificially boost the price or the volume of a security. So, it seems clear that we need a framework, and the question is how to get there. And all we're saying is, look, there's a simple approach, which is set standards for these platforms as they exist today. You can still debate that, oh, this particular one is a security and it really should have been registered. We're not saying don't debate that. We're saying put in place these standards now, and then you're not undermining any powers of the SEC or the CFTC by doing so. You're simply providing reasonable investor protection.
So Tim, your proposal says the same, partly it says that the same platform should be able to trade security tokens or commodity tokens.
Well, what we're saying is the same platforms are trading these things today. So how should we respond to that? We can respond by having, one track, which is enforcement actions of trying to pick off those things which are securities and force them to be traded on a securities exchange. But that still leaves the problem of those that aren't securities without regulation. And I think, most people would agree that Bitcoin and probably Ethereum and maybe one or two others, which is where a lot of the trading happens, are not securities. So you still don't have a federal regulator of that. Now you could say, well, okay, let's pass legislation that creates a federal regulator for those. But that what has happened is that has still been bogged down in this debate over, well, exactly how should we define what those things are? What we're saying is you don't have to do that. You can just say, look, any platform that trades Bitcoin or Ethereum today has to comply with the following standards. That is a simple way of asserting jurisdiction without getting bogged down in rewriting the definition of securities. And then you say, here are those basic standards, and they have to abide by them.
Yeah, I could not agree with Tim more. Yeah. So let's solve the problems that we can solve efficiently.
So I hear the word simple several times. If it's that simple, why haven't we done it? What is the complicated part of it?
Well, Regina, there are different ways to solve different problems. Some people say we're faced with a problem, let's come up with a comprehensive solution. And some people say we're faced with a problem, let's deal with it incrementally. There has been a push for a comprehensive solution when that's clearly not the most effective way to deal with this issue.
And,
Yes,
I would say also, I would just say also, when you look at what has happened in Congress, the fact is you have a wide range of views about this sector, right? You have some people who are very skeptical of the value of the entire sector. And the failures that we saw last year, instead of causing them to say, oh, we really need regulation, that those failures caused some of those people at least to say, well, this just shows it's a worthless sector. Let's not do anything that would legitimize it, including creating a regulatory framework. Whereas you have other people who say, oh, this is a very, interesting technology, very important technology. Let's not be too heavy-handed on the regulation. So you have a wide range of views in Congress. And we're saying, look, you don't have to resolve that battle over the value of this technology, right? You can put in place some standards and still debate those things.
Yes. And let me make just very clear. I say it's simple. Let me say why it's simple. Bitcoin has been decided. It is not a security. The secondary trading in Bitcoin. The public wants to trade Bitcoin. Whether Bitcoin's worth zero or a lot, I don't know, and I actually don't really care. But we ought to be able to bring some standards to Bitcoin trading based on our knowledge of spot market trading generally. That is not hard.
So Jay, since you brought up Bitcoin and whether it has value or not, but people are interested, the price is above 40,000 or something like that again. But yesterday, Jamie Dimon made the comment that he would like to see this all shut down. Any reactions to that?
But isn't that a great thing about America? We can all have our view on this. I think that Jamie Dimon was saying to central bankers and legislators, I would have shut this down a long time ago. I think given the take-up in the retail community globally and the desire of people to trade, that's no longer an option on the table.
Yeah.
And we should let the market decide whether it has value or not. But I would say, I'm guessing that if you told Jamie shutting it down, outlawing it is not an option, what's the next best thing? He would say regulate it.
Right. And the other thing
our markets are so well regulated. That is why they're so large. That's why they're so deep. If we talk about our traditional markets and FTX, Binance, they all make it obvious that this whole area needs to be regulated. It's a question of what kind of regulation. You've also proposed about having an SRO.
Yes.
How would this SRO be structured, this self-regulatory organization? What did you have? What exactly do you have?
Well, when we use the term SRO or self-regulatory organization, we mean that in the sense of how it's been used in U.S. securities and derivatives markets, right? Where SROs have been critical to our regulation of these markets. We've had them for decades. It was former Justice William Douglas, when he was SEC chair, who started the first securities SRO. So we mean an entity that involves the industry, that gets the industry expertise, but is closely overseen by the regulators. And in this case, we're talking about having a joint one that would be overseen by both the SEC and the CFTC. Now, there actually are SROs today that have responsibilities to both agencies. And so you could do that, and you could actually form it. It doesn't have to be an entirely new thing. You could have the existing SROs, big SROs like FINRA and the National Futures Association, basically assign some people to start it and then bring in, others. But the point is that by doing it through an SRO, you accomplish a few things. One is you get the industry expertise that I think would be very useful here. Secondly, by using an SRO, you can actually make the industry pay for it, which is what we've done in these markets. So that's the concept. It could be done without an SRO, but I think having an SRO would have many advantages.
there's one question from our audience, Richard Berner, who's asking, what is the industry's responsibility? It sort of goes to the SRO question a little bit. Industry's responsibility in agreeing on governance and best practices for their activities?
Well, again, the rules of the SRO, the board of the SRO, the rules that it adopts, right, the standards that it adopts would be approved by regulators. We're not saying, oh, let's go off and let the industry decide the rules for itself. So, you simply have to look at how FINRA operates, how the NFA operates, how they interact with the SEC and the CFTC to see what we're talking about.
So then this whole question about what is the jurisdiction of the SEC versus the CFTC under what is your recommendation there?
Well, we're kind of saying you don't have to worry about that with the approach we've taken, because the SEC and the CFTC could come up with some joint standards and basically use a combination of both their exemptive authority and their enforcement authority to get these platforms to comply. And I think, I think it would be very hard for platforms to resist this kind of thing if we took this approach. And basically the regulators could say, look, we won't bring an action to try to shut you down as an unregistered securities exchange or, whatever other enforcement actions they might have if you comply with these standards. They wouldn't agree to never bring any enforcement action against them, but they would basically say, if you comply with these basic standards, we won't try to shut you down. And that would be essentially the leverage. There are other sticks and carrots you could use, but that's kind of a main one.
I agree with Tim. The tools to create what I would say is the platform standards that we're discussing, they exist. You can pull it together. There's not just one. There are a number of tools that you can use in various combinations to get this done.
And does it require some creativity? Absolutely. Does it require the two agencies to work together? Absolutely. But we think that's eminently doable.
And look, we have litigation going on in this area. To the extent the SEC wins or loses, or wins and loses the litigation, the remedy is going to look something like what we're talking about.
Yeah. So Dave Michaels from the Wall Street Journal, Dave is asking, you wrote about the shortcomings of just relying on litigation to regulate crypto. And he's saying the SEC has lost some cases, like the Ripple case. And his question is, if the SEC loses more of these lawsuits, like Coinbase and Binance cases, is that going to set the SEC back quite a bit? And what will be the implications of that?
Okay, so the SEC has won every capital raising case, including the Ripple case. Right. The judge, I believe, found that the issuance in the initial issuance was in fact a securities transaction during the capital raising phase. Mm-hmm. The question in the Ripple case that I believe the SEC did not win was on the secondary trading, was that a securities transaction or not? There are other cases with similar facts where the SEC has won that. We will see how that plays out. But that goes to my point about secondary trading and Tim's point about secondary trading and the need to establish rules of the road, whether it's a security or a commodity, but that people are trading with the expectation of a financial return. And to go back to Dave's question, I think the SEC's record on cases decided is what, 95 and one's up on appeal. I'd say that's pretty good.
And I would just say, sooner or later, we will have standards for these platforms. The question is, how long is it going to take us to get there? I mean, we see that happening abroad. We see, Europe, the UK, Hong Kong, Japan, all moving much faster to basically clarify and create these regulatory frameworks. And it will happen here because I don't think the sector is going away as much as some people might wish it would go away. Again, I'm not making a comment on whether there is ultimately a terrific use case or value to Bitcoin or what that is. I just think it's going to be around for a while, at least. So sooner we can.
I agree. Let's just be, this is so missed so many times. There is a big difference in regulation between capital raising activities, the initial distribution, the syndication, the sale and distribution to the general public, and then trading activities after those securities transactions come to rest. There is a big difference. And it is frustrating to see so many people who seem to speak with authority who don't understand that basic difference.
Yeah, and you were talking about what other countries are doing. Is there something for us to learn from how other countries are approaching regulation in this space?
Oh, absolutely. I mean, look at Hong Kong as an example. You know, it's they they have a single regulator for their securities and their derivatives markets. So what they've said is kind of a version of what we're saying. They've said to these platforms, well, look, you'd better have registered as both under the securities regime as well as under this separate AML regime, which is essentially for the non-securities tokens, because we're not going to tell you which is which, but you need to comply with our rules. And so they're essentially articulating a set of rules that will apply to these platforms, regardless of, whether you say a particular token is a security or not. Europe is implementing a new framework under MiCA, their new law, the UK, Japan. So of course there's a lot we can learn. And again, the standards, as Jay said, the standards for secondary trading that we want, they're pretty obvious. This is not that complicated.
So is it more complicated for us because we don't have one regulatory agency? We have two, right? So we have a CFTC and we have a SEC. A lot of countries like Hong Kong, you mentioned, there's one regulator. For most countries, there's one regulator. Does that make it more complex for the US?
Look, I think it adds complexity, but let me go back to another point, which is what makes it much more complex. The US market, if you're an entrepreneur, if you want to raise money from the general public, you can't do it. I mean, you can spend tens of millions of dollars to try and do it, but in this jurisdiction, if you want to raise money from the general public, you have to be large, you have to be established, you have to have all sorts of bills. That's what we've decided with our securities laws. Most other jurisdictions have nothing compared to that. So their ability to deal with crypto transactions where you're talking about capital raising is much less constrained by their existing regulation.
And I would say, to your question, Reena, yes, it's because we have the two agencies, but it's also because the CFTC, neither the CFTC nor any other agency at the federal level has the power to regulate commodity spot markets, except, maybe in energy because you have FERC. So that's really that's the other part of the problem.
I couldn't agree more. I couldn't agree more with Tim. Think about these two things we have. Only big companies can raise money in the public. And we have no spot market regulator for commodities. We are facing those two realities in how we're dealing with crypto.
So, if the CFTC or somebody had the power to regulate those spot markets, you wouldn't have platforms, insisting so much, everything we trade is a commodity and that allows us to escape federal regulation, right? I mean, that's That's the flip side of the problem. And that's not unusual. I point out to people, look, you shouldn't be surprised by that. The CFTC doesn't regulate the spot market in any commodity. That's simply how we set up the CFTC, to regulate, derivatives on those commodities, not the spot markets themselves. So that's the other part of the problem. It's not simply that we have two regulators.
You mentioned that one of the challenges in Congress has been trying to do something very comprehensive. Last year at our Financial Markets Quality Conference, we had Senators Lummis and Gillibrand talking about their comprehensive proposal. It was a great start. And this year again, we had Senator Lummis speaking at our conference last month. And she was saying, that approach has been difficult. So things are being broken down into pieces. And whether it's stablecoins, AML related, they're splitting them up into pieces. And I want to get your thoughts on which pieces, especially talk a little bit about stablecoins, which pieces are likely to go through Congress. And we are also having changes in leadership in Congress, and what will be the implications of that?
Sure.
So what are you optimistic about?
Let me say a couple of things. First of all, I think Senators Lummis and Gillibrand have recognized the role that an SRO and development of joint standards could play more, the idea that we're suggesting. On stablecoins, though, clearly we need a framework for stablecoins. Where we are is that, again, stablecoins exist. They're being used primarily just for trading in crypto. Some people think they could have broader application. They pose risks and potentially opportunities, but we don't have a federal regulatory framework for that. So we're relying on state regulation based on very old money service business laws that aren't adequate, even though some regulators like New York, I think, are making, great efforts to create a good framework at the state level. We still need, though, a federal framework, as even the head of the New York regulator will say. And, the bank regulators, meanwhile, have taken the view that until there's federal legislation, we're going to limit interaction between banks and stablecoins. Now, my own view is the bank regulators, it's kind of similar to what we're saying about the SEC and the CFTC. The bank regulators could today, under existing authority, create the necessary framework. I've written about that separately. And that framework should basically address the risks that these pose as payment mechanisms. The risk of a run, the risk of failure to redeem, how are the reserves kept, what are the reserves invested in, as well as the illicit finance risks and so forth. We could do that. Again, other countries are doing that. And so forth. Other countries are moving along much faster on this.
Yeah. Look, I've written about this as well. I think Tim's views and my views overlap to a great extent. What do we know? We know that stablecoin is being used, and it's being used incredibly efficiently to engage in dollar-based transactions around the globe. Cash dollar-based transactions around the globe. What else do we know? We know that AML, KYC, BSA, all compliance with all of those regimes is essential. And what else do we know? We know that for a stable coin to be truly stable, it can't be a liquidity transformation device. It can't be backed by assets of low credit quality. You have to take credit and liquidity transformation off the table. Our banking regulators and our securities regulators, they know how to do all of those things. And if you put out guidance that addresses those things for stablecoin usage, you would go a long way in the right direction. And I think even the people who are very skeptical of crypto as a facilitator of illicit finance would think that that was a step in the right direction.
And this is just, I think, illuminated that we're behind generally in terms of the fact that we just don't have any federal framework for the regulation of payments. other countries have e-money laws, electronic money laws that regulate all forms of electronic payments. And we're, again, behind in terms of doing that. Because ideally, you would create legislation that not only addresses stablecoins, but sets up a framework for whatever is the next technology that's going to come along.
We do not want, we as a country, from a strategic position, do not want international payments to gravitate away from the dollar. And whether it's stablecoin or some other technology, it's pretty obvious the current technology is clunkier than it needs to be to accomplish AML, KYC, BSA, and stability and certainty in payments.
Yeah,
So,
and just to underscore, if I can underscore that, there is a huge, I think, potential kind of national interest in terms of the role of the dollar in us creating this sort of framework. Again, I'm not convinced that stablecoins can really scale up to be, an extremely important payment mechanism, but there's no reason why we shouldn't create a framework and see, both to address their risks as well as the opportunities.
The same kinds of discussion comes up when we talk about central bank digital currencies, right? That a lot of countries are doing a lot more than the US is. But then it's also, what is broken? What are we trying to fix, right? We want to be at the table, leading the discussion in terms of the technology, privacy issues, on stable coins, rather than letting China is ahead on using their CBDC. China is ahead of it, and the US has to make sure that we're at the table. But I get the point about we want to be careful. A lot is working quite well, and for other countries, it's not. Especially for developing countries, the payment systems tend to be a bigger problem. So they need to address it more than we do. But what is your general view on global competition? And the US needs to be concerned about we would be left behind in some way, whether it's the dollar.
Well, I think we clearly have to be concerned about the technology of cross-border payments. The issues involving a central bank digital currency are kind of separate from that in a way. Yes, they overlap, but there's some complicated issues to that as to, as you pointed out, Reena, do we really need it? And obviously people have raised privacy concerns, what's its effect on the banking system and so forth. I don't know that, my own personal view is, look, we should be doing research and thinking about this, but I'm not convinced that, the case is there. On the other hand, the case for making sure that cross-border payments are efficient is huge. The dollar is the global currency. It is the primary currency used in international payments. 95% of foreign exchange transactions globally take place through the dollar. What that means is if you want to convert Singapore dollars to UK pounds, there's probably one leg of that transaction where they're going through the dollar first. So we have a huge national interest in looking at how cross-border payments work and making sure that our technology is still, as efficient as it can be. And you're right that a lot of countries are looking at that. Frankly, I would say, countries even that have better payment systems than ours. I don't think it's a question of their payment systems are worse than ours. I think often their payment systems are already faster and cheaper than ours. They're looking at these things. Yeah. In some cases, they are countries that want to move away from the dollar and create, the means to make cross-border payments without using the dollar. But we clearly have a great interest in this, and I know that's shared by people at the Treasury Department, and I hope that that issue will get a lot once
again, Tim does a very good job of laying out what the really pragmatic state of affairs and concerns are. I want to add one more to that. Payments are a form of credit. It's the most short-term form of credit. But effectively, payments are, very, very short term extensions and acceptances of credit in order to facilitate transactions, whether it's, T0 like a stable coin or T, a little bit or a day or a week and the like. But it's not just the dollar, it's the treasury security. And it's part of an ecosystem where virtually all credit around the globe is priced off the treasury security, with payments being treasury securities for a day and other credit extensions being treasury securities for the similar maturity. We ought to be recognizing that ecosystem is in need of a technological upgrade.
I think going back, Tim, to your point about why protecting the dollar is so important. I think with especially the sanctions and what has happened recently, there are a number of countries who are quite interested in trying to see how the dollar can be bypassed. And they don't have to be part of the system and they can avoid sanctions.
That's absolutely right. And look, I'm not going to take a view, the issue of whether we've used sanctions too much or, not enough, that's a whole separate conversation. But it does come back to the point that we've got to make sure our technology is up to date so that we preserve as much as possible the role of the dollar. It's very interesting. Eurodollars are kind of like stablecoins in a way, right? When Eurodollars first started, regulators kind of didn't know what to do about them, because here you had the growth of these money-like instruments denominated in dollars happening abroad. Now, in the case of Eurodollars, they actually cemented the global role of the dollar, and cemented, frankly, the global role of U.S. banks, because things have to clear through banks, and transactions therefore had to have essentially kind of went through U.S. banks. With stablecoins, that's not necessarily true. And that's, again, why, we need a framework to regulate stablecoins, in part to make sure they aren't used for illicit purposes.
And to your point, Tim, so far, something north of 95% of stablecoin transactions are dollar denominated. But, that's not, I believe that if you had clear regulation and the acceptance of stablecoins into an effective regulated ecosystem, you would solidify that 95%, where there's no guarantee if it's a free-for-all that will continue.
And the other countries that are setting up stablecoin frameworks, those could be used not simply for stablecoins in their own currencies, they could be used for stablecoins denominated in dollars. We may see more stablecoins being launched from offshore jurisdictions that are denominated in dollars. All the more reason why we need to get our act together and implement a framework. We can't simply take the view that, let's not create a regulatory framework. Let's keep this out of the regulatory framework to minimize the risks that we're concerned about. That's not going to work.
So there's a question that's unrelated, but the question is, what role do custodians play in this regulatory setup for crypto?
Well, I'm not sure which the question is going to. There's two ways I might interpret that question. One is custody of customer assets. The other is custody when it comes to wallets, such as wallets used for stablecoins. When it comes to customer assets, we clearly need standards to protect customer assets. Some people feel, for example, that the custodian should be separate from the trading platforms. I think that's an issue you could debate, but we clearly need some standards to make sure customer assets are protected. Otherwise, we're going to have more issues like we saw with FTX.
Yeah, I think the question might be related to FTX and Alameda and the relationship between them and how customer assets were not protected. And in our
this is an area where we need an answer. Let's just say that an asset is a security. No debate about whether it's a commodity or a security, and it's represented in digital form as a token. The SEC should issue guidance on how you custody that representation of a security.
So in the last minute, what are you optimistic about in terms of legislation, regulation coming out, and what are you not so optimistic about? What's going to take longer? It's complicated.
Well, it's being made complicated. I'm not sure it really is that complicated. I guess I would say I'm hopeful. I'm always hopeful that we can get there. You know, look, if you're asking me for kind of what's the outlook in terms of legislation, I would say there's probably a better chance that we might see stablecoin legislation because I think the issues that at least were debated within the House Financial Services between Democrats and Republicans, you know, it was a set of issues that I think one can find a good compromise. The bill that came out of committee got a few Democratic votes, not as many as one might like in terms of really saying, look, this is a bipartisan product. You know, in terms of implementing a regulatory framework for crypto trading intermediaries, again, I think the proposal we're suggesting could find a consensus much more easily than some of the more complicated proposals that have been made.
So like my view is there's a false trade-off between investor protection and other regulatory aims and facilitating capital formation innovation. I think you can enhance both at the same time. Each of the incremental steps that Tim and I have laid out would do that. Adding clarity to what kind of platform you can trade digital assets on, that would be helpful. Having custody rules that made it clear how to custody digital assets, that would be helpful. Having clear stablecoin guidance as to what's a stable coin that the US banking system can support and that's not a security, that would be, each one of those things would enhance investor protection, would enhance capital formation, and would allow innovation to flourish. Take the wins that you can.
Fantastic. Jay and Tim, your proposal is, I'm sure it's going to get a lot of attention. It already is, and people are looking at it seriously, and some in our audience are following what you are putting out in a very thoughtful way. And I just want to thank you on behalf of the Passaros Center, and for our audience, thank you for being here. And please follow us on social media on our different sites. And we will put this up on our YouTube channel, the recording, so that it's accessible later on also. Again, Jay and Tim, thank you so much.
Thank you.